Hey everyone, welcome back to Corporate Decoder. Today, StratCap Digital Infrastructure REIT incorporated its latest 8K filing, and it is all about how much their digital stuff is worth, their net asset value, and I am seeing a little something interesting in how they value their properties. Quick note, this is not financial advice, just my take on public filings for educational purposes. So, the company just reported their net asset value as of the 30th of June 2026. But the really interesting part for me is how they're getting to those numbers and what assumptions they're making. Alright, so on the 24th of July 2026, StratCap Digital Infrastructure REIT Incorporated announced their updated estimated net asset value, or NAV, for all their different share classes and partnership units as of the 30th of June 2026. Think of NAV as the company's best guess at what all its assets are worth minus its debts, divided by the number of shares. It is a way to see what each share is truly worth. They've laid out the NAV per share or unit for each class of stock. For instance, Class A shares are valued at $9.6225 per S-share, while Class X shares are a touch lower at $9.6076. Class I shares are at $9.6357, and Class IX shares are $9.6138. Then you have Class T shares at $9.6989, a bit higher. The limited partnership units, Class P and Class PX, are valued even higher at $9.7187 and $9.7165 respectively. It is interesting to see these slight differences between share classes, likely due to different fees or investor rights associated with each. The company stresses that its NAV is calculated according to specific guidelines approved by their audit committee and board of directors. Their advisor, StratCap Digital Infrastructure Advisors II Incorporated, does the calculation, and the audit committee reviews it. They also mention that their independent valuation advisor checks if the assumptions and methods used by their main advisor make sense, but the main advisor is ultimately responsible for the NAV. This layered oversight is pretty standard, but it is good they're being transparent about it. Now, let's dive into what makes up this net asset value. As of the 30th of June 2026, the investments in real estate are valued at about $38 million. Then there is investment in DataCom JV at a much larger $50 million. Cash and cash equivalents are a healthy $27.5 million. The rest are smaller items like receivables and other assets, balanced against liabilities like accounts payable and a significant loan payable of $18 million. Putting it all together, the total net asset value for the company is approximately $112 million. This is the number they're using to determine the value per S-share. There is a footnote here. Number 1, that is a bit of a mouthful, but important. It explains unamortized expense support repayment. Essentially, this represents operating expenses and organizational and offering costs that the company paid up front, but are being recognized over time. They're treated as an asset currently with a benefit over 4 to 5 years. As of the 30th of June 2026, there was over $13 million in this category that still needs to be amortized. The advisor has a promissory note to repay any unamortized amount at the end of these agreements, and even a guarantee from AIMHMC Capital Limited. This is a common practice for REITs, basically deferring certain upfront costs and recognizing them over the life of the agreements. It means the stated NAV is higher today because these costs haven't fully hit the books as expenses yet. Looking at the breakdown by share class, we see the total net asset value is about $112 million again. The number of outstanding shares varies significantly. Class A shares have over 4.2 million outstanding, while Class T shares have a much smaller 69,793. This is why the NAV per S-share differs across classes. Even with the same total assets, more shares mean less value per S-share. The NAV per S-share, as mentioned, ranges from about $9.6 to $9.71. The highest NAV per S-share is for Class P units at $9.7187, and the lowest is for Class AX shares at $9.6076. Now, for a bit of what goes on behind the scenes for valuing these properties, they use a discounted cash flow method, and here is where we see their assumptions. For cell towers, they're using a discount rate of 6.60%. For data centers, it is a higher 7.25%. This discount rate is essentially the return they expect their investors to want from these types of assets. A higher discount rate means they believe the asset is riskier or expects less future return, thus valuing it lower today. They also use an exit capitalization rate. For cell towers, it is 4.24%, and for data centers, it is 6.25%. This rate is used to estimate the property's value at the point they might sell it. Again, higher rates mean lower expected selling prices. What if these assumptions change? The filing gives us a sensitivity analysis. For cell towers, if the discount rate were to decrease by 0.25%, the investment values would increase by about 2.04%. Conversely, if the discount rate increased by 0.25%, the values would drop by about 1.99%. That is a pretty direct link between the assumed discount rate and the perceived value of their tower assets. For data centers, a 0.25% decrease in the discount rate would boost investment values by 1.89%. An increase of 0.25% would lower values by 1.85%. It shows how sensitive the reported net asset value is to these key assumptions. The company is essentially saying if interest rates change a little bit, the value of our digital infrastructure could move by about 2%. This is a pretty standard disclosure for real estate valuation, but it highlights that NAV is an estimate, not a hard fact. Here is a reconciliation of their financial statements to the NAV. Their total equity as reported on their balance sheet is about $73.7 million. To get to the NAV of $112 million, they add back things like unrealized appreciation of investments in properties and DataCom JV to the tune of $22.5 million. They also add back accumulated depreciation and amortization for about $3.4 million, and crucially that accrued expense support repayment of $13 million we saw earlier. This difference between GAAP equity and NAV is where the real story often lies for REITs. GAAP, or generally accepted accounting principles, requires them to depreciate their properties over time, meaning their book value goes down even if the property's market value goes up. For NAV calculation, they're trying to reflect the fair market value. So they add back that unrealized appreciation, the increase in value that hasn't been formally recognized yet in their financial statements. This is why the NAV is often higher than their GAAP equity. It is not that they have more cash, but their assets are valued differently under NAV rules. So what is the takeaway here? StratCap Digital Infrastructure REIT Incorporated is being transparent about how it values its digital infrastructure assets. The NAV reported is an estimate based on current market conditions and assumptions about future performance. The slight premium in NAV over GAAP equity comes from valuing their properties at fair market value rather than depreciated cost. The sensitivity analysis shows that interest rate changes can impact their NAV by a couple of percent, which is normal for this kind of business. The main risk I am watching is how sensitive their NAV is to changes in discount and capitalization rates. If market conditions shift significantly, their reported net asset value could see substantial swings. What I'm actually looking for is to see how consistently they can achieve the valuations outlined by their advisor in the future, and if their actual property performance matches these optimistic assumptions over the long term. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, smash that like button and subscribe for more. Check the Discord in the description too.